Welcome to AllGen's Market Update. My name is Jason Martin. Today is March 26th, 2020, and wanted to keep you guys updated with everything that's going on in the markets. A lot of people are a little bit more concerned, especially here locally in Orange County, with a lot of the shutdowns going into place. To bring some highlights of what's going on in the market and what we're doing about it. So let's jump right in. Here's the things that we're going to talk about today. We're going to give first an update of what's been going on in the stock market itself, highlight the stimulus package that's been coming out over the last few days, talk about how the stock market is a forward pricing mechanism, and then we'll talk about where we're going to go from here. So jumping right in, looking at the S&P 500 here, you can see this goes back to 2016. Just wanted to be able to show kind of this recent drop in the market and give a little magnitude of it. So a pretty big drop, and it was pretty impressive from the standpoint of how quickly it happened. Literally happened in about a month. But you had almost a 34% drop from the peak of the S&P 500 down to the trough. And we're recording this, or the slide goes from 11:34 this morning, but the recent bounce, which has been encouraging to see over the last few days, has been pretty impressive too for a 3-day period, is 16%. Now we're speaking intraday and we're recording this video intraday, so that could change, but as of 11:30 on March 26th, the gain from the bottom just in the last few days has been a 16% bounce. But as you can see, still quite a bit below the top in the market. So that's what's been happening over the last month in the market. Let's kind of hop in. One of the reasons for the bounce is that both the Federal Reserve and from a fiscal standpoint, there's some pretty enormous stimulus packages being put out. And so I'm going to first talk about the fiscal policy, which is an amount of $2 trillion. It's a busy slide, but there's a lot of things in this, and this hasn't passed yet. And I'll talk about that in a second, but it looks like it's going to pass. So basically the allocation of the $2 trillion, $250 billion is going to be direct payments to individuals. $350 billion is going to be in small business loans, $250 billion in unemployment insurance benefits, $500 billion in loans for distressed companies, $130 billion to hard-hit hospitals, and $150 billion to state and local governments needing cash due to the response to COVID-19. So get into some of the details, though. For the payouts, individuals who earn $75,000 in adjusted gross income or less get $1,200 each. They haven't come out with the exact date of when that is, but that will be coming soon. And so married couples earning up to $150,000 receive $2,400 and an additional $500 per child. So the payment will scale down by income, phasing out entirely for $99,000. So basically from $75,000 up to $99,000 for singles or individuals, it's going to scale, so you won't get as much if you make over the $75,000 amount. And then once you're above $99,000, it doesn't appear that you're going to get a check at all. And then same thing for married couples. Once you get above $150,000, it's going to start to phase out all up to a certain amount as well. I believe it's $198,000. So that's some of the details of the package. Now, some of the notes is that, you know, to a lot of the distressed companies, they're going to have access to loans. But, you know, some of that's okay, great, we'll have access to keep going, you know, with the economy. I'll be able to keep making payroll and things like that and borrow, but, you know, usually you have to pay back a loan. Well, this is the good thing in this bill from that standpoint of helping the economy is that if you, under the new program, the loan money that businesses use to cover payroll expenses, rent, interest on mortgage obligations, and utilities will be forgiven. So obviously they're trying to encourage the loans to be able to keep paying your employees during this time, obviously to be able to keep your business running, to pay for rent and those types of things. So, what was encouraging as well is that first time in a long time, both sides of the aisle came together, at least in the Senate, and passed this thing 96 votes to 0. So it's going to go to the House vote tomorrow on Friday, and it looks like it's a good probability that it will pass, but not 100% guaranteed. So. All right, so that's one piece of it. The other part of it is what's going on with the Fed policy. So the Federal Reserve is doing a stimulus package of essentially around $4 trillion. And this is not 100% clear yet, but we know it's a massive amount of stimulus. And what this is basically is quantitative easing. And we've talked about quantitative easing and quantitative tightening in the past, but essentially quantitative easing, some people call it printing money. So basically you're creating money and you're using that money to buy, a lot of times in the U.S. it's buying bonds. In this case, they're going to be buying U.S. Treasury bonds, mortgage-backed securities. I've also heard some things where they're going to buy corporate bonds too. Another big thing that they did, some of these amounts are not fully out and fully detailed yet either, but another thing that they've done outside of quantitative easing and printing money in the attempt to stimulate is they've also lowered interest rates, and they've lowered them quick all the way down to 0 to 0.25%. So all of this is meant to stimulate the economy, help people if they're going to borrow to buy a house, borrow to buy a car, or even more importantly from the stock market standpoint is for businesses if they're going to borrow and for a manufacturing facility or whatever, they're going to have interest rates lower than normal, and so that will encourage them to borrow and to invest and to spend. And it's also if you have variable rates, it's to reduce down those payments to allow more money to get into the economy. So in a big part of this package, especially the stimulus package on the Fed side, is to have systems in place to keep the banking system working properly. There's a lot of things that goes on behind the scenes in the banking system, and they need the liquidity to be able to lend, so that the banks don't start to become really tight. So they've come out with an enormous amount to kind of help everything to work properly. Now, is the stimulus package going to help? It certainly it will help from the standpoint of it provides a lot of money to kind of help people the people that are gotten hurt by losing their job, or businesses that are not getting the revenue that it would normally be getting. It'll help it'll help worsen the blow of some of those economic troubles that can happen right now with a lot of economies kind of shutting down. And the same thing from the stimulus package, a lot of money's being thrown at this. So I do believe it can help, but it's not the cure. Okay, what really needs to happen is people need to go back into living their normal lives, working in their normal lives, and that's the big unknown. When is that going to happen? The president has said he'd like to see things start coming back online in Easter, but that's still an unknown. So, but that's, it's good that they acted quick. It's good that they came out with a large amount. At the same time, we need, the sentiment and the confidence and people to be able to travel again and to be able to live out their normal lives. That kind of needs to happen, or at least we know that it's coming soon in the future for the economy to really rebound strong. And so we're not quite there yet. So this is just a good visual to show from a quantitative easing standpoint how much the Federal Reserve has already acted. So this chart basically shows how much is on the balance sheet of the Federal Reserve. And so, so as the line is going up, it means we're creating more money and buying more bonds, and that's stimulative. So this chart goes back to 2008. You can see after the financial crisis, they put in a lot of money in early 2009, and again kind of 2011 and 13 through 3 phases of quantitative easing. Then we started to normalize and stop doing that in 2015, stopped printing the money, stopped doing the quantitative easing, and then started to reverse it by doing quantitative tightening and starting in 2018. And that went all the way until towards the end of last year. And now you can see most recently what's gone on. It has just really spiked, which means they've already started creating a lot of money in buying bonds to try to stimulate that economy, stimulate the economy very quickly. So I want to talk for a second about the market being a forward pricing mechanism. What the heck does that mean, Jason? So a forward pricing mechanism is, see, a lot of times people say, you know, if the economy goes into recession, the stock market is going to fall. And so sometimes when the news comes out that says we're officially in a recession, people think that the stock market's going to fall. But it's actually the other way around. The stock market goes down anticipating a recession, and it also starts to come back up anticipating a recovery or an expansion, and that happens before the news comes out. So just an example here, the shaded areas here are recessions. So you can see there was a small one in 1990, but I wanted to point out this one in 2000. You can see the stock market started to go down prior to the recession happening. And the thing is, when this shaded area starts, at the time that you're in the recession, you don't know it's a recession. The recession doesn't get announced almost towards the end of the recession. Does it become officially you're in a recession? So by that time, you're already over here. So the market already came down during that time. Now, this example in 2008 is even better. You can see we started to drop before the recession, way before the recession was announced. And then, but when the recession ended, the market had already started going up prior to the recession ending. And the reason I say that is it's a good chance we're already in a recession or we're going into a recession. But I say that, you know, understanding that a lot of times people will associate that, well, that means the market's going to drop. No, it doesn't. In fact, it's the other way around. A lot of times the market drops, and as I showed you on one of those first slides, the market already dropped 33%, anticipating the recession. So that when I say the market is a forward pricing mechanism, it's anticipating what's going to happen in the future. So yes, we may be going into a recession. There's a pretty good chance of that happening. At the same time, on the flip side, the market will most likely rebound in anticipation of a recovery. So we don't need the recovery to happen for the market to go up. Eventually, obviously, that needs to happen. But when the market starts to figure out, okay, it looks like the worst is over, and it looks like in the future we're going to start to turn, and the economy is going to start to rebound, the market will start going up prior to the actual rebound in the economy happening. So I think that's really important to understand because a lot of times people think when they see the news headline, we're in a recession. Oh no, we should sell. No, the market already anticipated that. At this point now, the market's searching for the time when we're in a recovery to start going up prior to the recovery actually happening. All right, so in summary, you know, the market had a huge drop in a very fast time frame, one of the fastest ever, big drop, but then now we're experiencing the first rebound. We'll see if that continues. It's encouraging right now, but I'm not trying to call a bottom. You know, we don't know how long this is gonna go on for. Part of this first rebound, I think, is because we were able to put through a stimulus package, and both from a fiscal standpoint and from a Federal Reserve standpoint, and that's going to help. But what we really need to have happen is people to start to live normal lives again, and we're still a ways off from that. But at the same time, remember that the stock market will drop prior to a recession. Stock market's already dropped, and at the same time, it'll also go up prior to a recovery or an expansion. So as a heads up, over the last month, we've gone through all of our portfolios 2 times, rebalancing, selling bonds that have gone up, buying stocks that have gone down. Prior to this, we were very defensively postured, which helped protect the accounts on the way down. At the same time, now that bonds have gone up a lot, we're near 0% interest rates, and as stocks have gone down quite a bit, you need to take advantage of those times to sell some bonds and to buy some stocks. And we've done that, and we've done 2 rounds of that. However, we're still cautious with that. We're not doing huge moves. We're doing a few percentage points at a time so that we can still maintain a defensive posture in case it does get worse. But at the same time, we got to try to take advantage of low prices in stock, and over the long run, that usually works out really well. So thank you for watching. I hope this helps. We'll see you soon. If you haven't done so already, click here to subscribe. We frequently upload market update videos on the coronavirus, provide financial planning tips, and relevant personal finance topics on our channel.